Welcome back to 5 Charts and 5 Charts only. Today we'll be talking about the S&P 500, the VIX, the KRE Regional Bank ETF, the EUFN European Financials ETF, and then finally bonds. So let's start with the S&P 500 since we always do, and with this chart first. And what this is showing here are all the 1% gains and losses that the S&P has logged since April 21st. The question is, why April 21st, not the low? Well, because this happened to be the first key higher low that the S&P 500 was able to log during this extremely volatile time. And from that point, that's when the bullish patterns really started to form. We talked about this various times over the last few months, but if you're really locked into that spot there was a short-term bullish pattern in there, which gave way to a bigger one, and then a larger one after that, so forth and so on. But after that point, things started to slow down. Again, you usually have a lot of explosive movement from the beginning, even a few weeks in. But after that, after we had those few days in a row of positive or 1% gains, things started to slow down, especially with the amount of 1% declines. So as we know, this past Friday, the S&P 500 logged a 2.7% loss, right? The biggest since the middle of April. Hadn't even seen a 1% decline since August 1st. And so what we're showing here are not only the times we've had 1% losses, but the 3 times again since the April low when we had a 1% loss followed by a 1% gain. And needless to say, the last one occurring on August 1st and then August 4th, the Friday following that weekend, led to one of the best buying opportunities we've seen over the last few months. And again, the same thing happened here in the middle of April. So from this perspective, we know that all dips have been bought up to this point. It seems like another obvious spot for that to happen again. And so far, a few days in after that big decline, there is, of course, an indication that buyers have stepped back in, but we're still below the most recent high. So, of course, we have some more work to do. So the big concern, needless to say, is because this was arguably tariff-driven, then we have to go back to what happened before April 21st, right, in 2025. So these are all the plus or minus 1% moves that took place from January 2025 all the way up until April 20th. And these are all the times, again, shaded in yellow, when we had consecutive 1% moves both up or down. And as you recall, it was extremely difficult to sit through from a trading perspective and getting whipsaw and so forth and so on, because as you can tell here, the majority of those trading days were 1% gains or losses, and many of them much more than 1%. Remember, those last two on April 3rd and 4th were over 4 and 6% respectively. So it was obviously a much different environment. And so the obvious concern is that near 3% decline that just happened on Friday, could it eventually lead to a much longer period of big moves once more? And we don't want to sit through a 20% loss within a few weeks, but because of recency bias, we know it is a possibility. So one of the things that we'll be looking at, of course, and really the number one thing, is what happens next to the patterns. As we last talked about, we just had our last upside target of 67.45 get acquired. That's obviously positive, but it left us with no more upside targets, at least bigger ones. So at the time, we talked about that being a jump ball where, we're up almost 40% for the S&P 500, no more big upside targets. It's up to the bears to do something about it right now. And so as a result, this is what we have potentially going on. This is the exact same chart, right? A bullish version and a bearish version. As we can tell, both of these patterns are potential scenarios where we simply get a move back to the highs and then above. We can call this a cup and handle pattern of some resort. We'll see what it looks like. As of right now, best case scenario, at least to keep this clean, is to make a return to say 67.50 or thereabouts, pull back again, form a higher low, and then make new all-time highs with that, with a pretty substantial target, say 200 points or so higher at that point. Now, on the downside, of course, anything that fails at this point, really to make a new high. We could call that a lower high, of course, which according to this chart would resemble the right shoulder of a potential bearish head and shoulders pattern. Needless to say, then that would be about 200 points below, right, down to 63.50 or so, which would be the target. So a lot has to happen for a bearish pattern number one to become live, but more importantly for that bearish target to get acquired, meaning that at that point we'd have a successful bearish pattern. As we know, that has not been in place since the lows in April. So these are the ones we're looking at, of course, and if we do in fact get that downside break, you would think that would come with a lot more volatility in terms of 1% moves, and much different than what we've seen between last Friday's debacle and the following big move this past Monday. There were very long streaks of both no 1% declines, 48 straight days, and then over 30 without a 1% gain. And so probably not going to have a run like that again soon, but you never know. We didn't think that was going to happen in July or September either. Okay, so moving on, the VIX. And as we know, and not surprised to see, of course, was that during that big decline last Friday, the VIX popped, right? And if you measure this from the most recent low of September, that yielded pretty sharp 56% gain or spike. And so anyone who was trading in VIX futures or anything related to volatility and nailed it, of course, that's a pretty substantial move. But it's interesting if you look back at some of these moves going all the way back to the summer of 2024, there were a number of strong, really substantial moves in the VIX, 57%, 53%, 40% almost, 53%, 48, so forth and so on. None of those did really anything to alter the S&P 500, meaning just a little bit of a downturn, right? We know each one of these along the way here hasn't been more than, say, 3 or 4%, but they produce huge moves in the VIX. So when we hear about the VIX spiking like this, it's really just a normal move for the VIX, especially when we haven't had a lot of volatility in the S&P 500 itself. So we can see the difference, right? When the market really fell apart down 20%, we had multiple moves, 50%, multi-day advance of nearly 100%, pullback, and then the other one, 250%. I mean, that's a big move in the VIX, and we know what that came with, right? That's when those 2, 3, 4, 5, or 6% moves to the downside were happening. Same type of thing, of course, back when the market pulled back just about 10% from the July high to the August low in 2024, right? Had 80% move, a small pullback, and then a near 300% move, right? So there's no way to time this, so to speak. This is more to speak to the VIX just moving, say, just 50%, trying to scare us because, as we can tell, it only coincided with a 3% decline for the S&P 500 from peak to trough. What I think is more interesting and maybe more concerning to think about is this perspective. This is a weekly chart of the VIX. And this shows that a lot of volatility back and forth, but overall, the VIX has been making higher lows since last summer. Now, we know what happened again for February to April, but notwithstanding that, think about what occurred from that point where the S&P continued to flow higher after bottoming right in July, August last year, continued to move higher through the end of the year. But the VIX, even though it didn't really do much on the upside, it kind of respected this area as well here. Again, making higher lows the entire time, which still is doing now. And the reason why we should not ignore that potential is because we saw the same type of action occur in 2021. Again, from the summertime there all the way through the end of the year, the VIX was making slight higher lows as the S&P 500 continued to make higher highs. And of course, that didn't matter until the beginning of 2022. So who knows how long divergences like this last. But this, again, keep this in the back of our mind, because if the VIX is doing one thing which it shouldn't be doing, that eventually could lead to much more of a pullback from equity perspective. And don't forget as well, we don't really need big spikes. One of the things that traders were talking about during 2022 was that the VIX never had that capitulation-like activity. I mean, look at how different this was. It would arguably in controlled trading range here, even though it was moving lower, compared to these huge spikes we saw now twice in the last 12 to 14 months. But more importantly, it was hovering around this area, right? And so let's just keep this in mind again. as we get into the end of the year, into next year as well. And so as we know, the small caps have been coming back. Two big reasons for that, of course, have been biotech doing very well. That's 10% of the R2K, as well as regional banks. And we started to talk about this earlier this week just because we knew that all the big names at least, starting to report. So eventually the KRE Regional Bank Index, or ETF, will become a talking point too. And so as we can tell, this is a weekly chart. Looks pretty constructive. There's a pretty undeniable inverse head and shoulders pattern here, with this right shoulder potentially being formed right now. And if we have good responses to the financials, especially regional banks, as we know, then eventually can make the case that it can get back up to this neckline and push through. Now, if we zoom out a little bit, we can tell that entire spot here, right, going back to 2025, is one of a few bullish patterns that are now potentially in play, with targets of 73, 83, and then the potentially very big one that dates all the way back to 2022 could eventually get completed as well if KRE can continue to come back and eventually push through the high 60s, low 70s here. And if we zoom out even more, we can tell that entire thing here is just part of the KRE's comeback all the way from the great financial crisis low. As we know, still below its highs from late 2021, so eventually gets up there. We'll see how it looks, but that could be an even more substantial breakout. That's why we always should keep the KRE on our radar screens, again, because it's such a big piece to the small cap IWM following through on its own breakout and new all-time highs. And so also the EUFN, European Financials ETF, has been really impressive going back a number of months now. Now, we know that it was in a really long, drawn-out range for quite a few years before that. Made a huge turn near the 2022 low and just ripped higher, basically doubling from that point all the way to the end of 2024. And just when it looked like it was about to test the height or the high of this big trading range near 28, guess what it did? We know. It broke out to the point where so far in 2025, this is a monthly chart, it has been overbought the entire year, even when the ETF pulled back below that breakout zone earlier in the year, because this indicator relies on closing prices. So because we had that big reversal in April, it never undercut that on a closing basis, which then kept the RSI at a lofty price here. So currently around 77, and we know this can continue, but we've been saying that for the last number of months. So far, the breakout has held. Now, if we zoom in a little bit now to the daily chart, we can tell that it really hasn't done much at all, even though it continues to move higher over the last few months. Just been this kind of consistent back and forth movement, but all of it taking place above a rising 50-day moving average. So what's interesting about this right now is that we have a negative divergence here with the daily RSI, less being overbought in the beginning of August and slowly making lower highs along the way as EWFN has made new highs, but then kind of slowed down. So this is a potential negative divergence, but we could have said the same thing right here, right? During the summer months when the RSI, again, last topped back then in the middle of May, was moving lower all the way to the end of August. And then what happened? We got the breakout, rallying from the 50-day moving average, which now EUFN is trying to do again now. And so it's a very interesting scenario considering that financials overall are doing better, and Europe, of course, continues to do well as well. So what we want to see, of course, is the same type of thing which just happened a few months ago, see a breakout once more. And this is how, even with a very overbought monthly RSI, things can continue higher. So lastly, let's talk about bonds, starting with the 10-year yield. And as we know, it's been struggling to get back above 4.2. And we can see why. When it broke below it, it also completed this descending triangle pattern and it stayed below it since that point. And so the more it has failed to get back above that zone, the greater the chances that breaks below 4%. And once that occurs, right, that could sound some alarms only because It's a round number, and it hasn't traded below that on a continuous basis really since 2024. Now, it did so during the tariff tantrum, but that was very short-lived. And so now this looks like the real pattern break as it goes. And because of that, of course, it's making bond prices do well. And so this is the TLT, and it's finally back above its own 200-day moving average here, trying to hold above its breakout zone, very similar to the breakdown zone from the yields. Just has to get a little bit more momentum to get it there. And, we've seen this happen before. We've seen it get back above the 200-day moving average in the past, or get close to it. And so far, over the last number of months, going back to end of last year, this hasn't happened. And so it still needs to do work for that to occur. And again, that may mean that the 10-year yield eventually have to push below 4% for that to occur. And lastly, this one isn't talked about as much, but the IEI 3 to 7 year Treasury bond ETF. If you're thinking about looking for bases, this is obviously a great example of one, with this base being in place since the ETF bottomed in late 2022, has been slowly making its way back up to the top of that range. Right now, this looks much more similar to the 10-year yield than, say, the TLT does, and not surprisingly is because it's looking at 3 to 7 years as opposed to 20 years, or 20-year plus, which the TLT is at. And so as we can tell here, getting close to potentially breaking out from this 120 zone with a lot of air above it. So needless to say, it's relying upon yields moving lower, but this is going to continue to be on our radar screen for the next few weeks to months. Okay, don't forget to check out our free Substack newsletter, CappNotes, where we put on a lot of premium content from our opening look piece. That's a lot of high-level market analysis. Then we drill down to the key ETFs, putting in some actionable charts there. And of course, chart trades, which are individual stock ideas, where we talk about entry levels, exit spots, risk levels, so forth and so on. And you'll see some other videos on there as well. Again, that's capnotes.substack.com. See you there.